So today I'm going to talk about challenges and opportunities, data science in insurance. And that's partially from the experience I had over the last year at Hastings Direct. Bit about me, I've just finished a PhD in pure maths, not theory, and have worked at Hastings Direct as data scientist since February last year. As I said, challenges and opportunities, data science insurance, or I like to call it pulling actuaries in the 21st century. Overview of the talk. First I'm going to talk a bit about Hastings Direct, overview of Hastings Direct, and then what we have now in terms of data, workflow, hardware, software, particular challenges at Hastings Direct, then reasons for change due to data science in general, then what has to change in terms of hardware, software, working practices, particularly in insurance, then potential problems with the whole process, opportunities for insurance and for data scientists, and then also going to give a short summary. Right, Hastings Direct. First, one of the fastest growing general insurance providers. That's an agile, data and digitally driven business. It's built, yeah, you can read that. This is the only slide I got from our internal communications, so that might be slightly weird. It's part of Hastings, went public 2015 in October. The underwriting for car, bike and van is done through a Gibraltar daughter company, Advantage. Home insurance provides through a number of panel partners and co-insured with AXA, and now since I think last week, Thursday, also by Hastings Direct directly. With over 2.1 million customers, I think it's 2.2 by now. How many? 2.3. Sorry. With over 2,500 colleagues in 3 sites, Bexhill, Leicester and Newmarket. And the vision is to protect 1 in 10 by 2020. So that's car insurance market. Right, so now to my slides. The main problem of car insurance or insurance in general is, in car insurance, is how many accidents is a customer likely to have and how much are they going to cost. Now, this is hard because it's hard to look into the future. Also, the uncertainty is surprisingly large. We tried modeling the number of claims and we got an accuracy of about 0.5. That's fairly low. We have an extremely imbalanced data set, so most customers don't have an accident and most accidents are not that expensive. Then there's some factors we are not allowed to use, like gender. And data quality is also an issue because some data is good, some data is estimated by the customer and therefore bad, like how many miles do you drive in a year? Basically no one knows that. Our workflow at the moment in terms of pricing works as follows. So we have data that you provide us at the quote stage here. We then use that in the actuarial department where I work as well to basically price your pure risk. This is multiplied, this is then turned via GLMs into a tables or set of tables, many tables, and multiplied with a so-called base price. Then we have the pricing people, pricing guys, they sit in underwriting as well. They basically segment balancing and ensure that we don't have too many, say, 45-year-old males and other people. And then the last part is retail. They do the price optimization when you ask for a quote, depending, for example, how likely you are to pay a little bit more. But you can ask them themselves. They're somewhere around here. And yeah, everything is based on tables, as I said. And then over the price of your policy, over the life of your policy, we get more data about your policy while you're a customer. If you have a claim, we also have that claims data, and that then goes again into the risk tables if you renew. Right. The problem with this is we have extremely long feedback loops, so it takes in excess of a year to know if you had an accident or not, because then I think you can claim up to 6 years afterwards or so. There are some technical challenges. We have about a few 100 million quotes a year. We have less than 1 second response time per step here. And we have between 5 and 1,000 quotes per second. And the aim of the whole thing is to get personalized prices for everyone in smaller risk pools. Data overview. So what data do we have? We have customer data that's given to us at the quote stage or when you call to get the policy. We have third-party data like, for example, your credit score. We have data if you have a claim. Again, data that comes from the customer about the claim, on third-party data, for example, if it's not your fault and another insurer gives us data, or from the garage, for example. And then we have, I put this extra, data enrichment, location data, location-based data. We have vehicle-based data, for example, how much horsepower does it have, what's the market segment of your car. So do you have a Golf class car or do you have your SUV or so? And then we have personal data about you, as I said, for example, the credit score, but also other data. Yeah, as I said, third-party data can be bought in, for example, the credit score. It can also be other source of data, for example, the government website has a lot of data as well. Problems. You cannot ignore data quality. It's okay once we have a policy. That's fairly good because people tend not to lie when they're on the phone. This guy, that's Joseph Stalin, has about 25 cars, I think, and lives with Hitler in Buckingham Palace and a few other places. So the quote data is basically crap. Claim data is quite different. Claim data is probably the best data we have because once you call about an accident, you're not lying, generally. Third party is a very mixed bag. Some of them are really good. Some of them are awful. But they are generally very expensive. And then we have the thing about missing data. It can either be properly missing, so we don't know it, but we would like to know it, or it can be, well, I call it missing, but not missing. It's, for example, data about a second driver if you have one driver on the policy. Yeah, tech stack. We work in a Windows-only environment, which makes using R fairly challenging because you can't really parallelize things, for example. Data is stored in a SQL Server 2008, which is fairly old. But we might be getting a new service soon, hopefully. We now have Netezza as well. If anyone knows that, it's not my favorite. Since 2016, we have Guidewire, which is kind of a general IT environment for the insurance company. It covers a claim stage, it covers a policy stage, covers a quote stage in mostly at the call center. And then quotes are done with Guidewire and Polaris, and as said, they're usually based on tables, which makes it hard because it's hard to turn a random forest in a small finite number of tables, if you ever tried. Current challenges, well, as I said, we are limited to tables and we have this time and resource limit. The idea of the environment, it's Windows only. We have old software, we have old architecture, as I said, SQL Server 2008. And with this, we have an IT culture problem because they're very focused on stopping things from happening because most of the company is a call center. And then we have some regulatory and feedback problems. It's a fairly conservative industry in insurance compared to other industries. We don't really have a problem with using new models. Apart from the tables problem, we have a problem that we're not allowed to use everything. For example, we're not allowed to use gender in pricing, even though it's fairly predictive. And we are not allowed, for example, if you pay monthly, we're not allowed to price insurance rates based on your credit score or your likelihood to pay. And as I said, we have an extremely long feedback and review loop of in excess of a year. Right. So the reasons for change. Well, data science in general is developing fairly fast over the last few years with new methods. Going to get back to that in a second. We have far more new data, for example, geographical information which we weren't able to get or use beforehand. There's a problem with analyzing that because it's fairly large and takes a lot of resources. Telematics is another big driver at the moment because it changes quite a lot of things. For example, you have a far shorter feedback loop because I can see immediately what the driver is doing as soon as he or she starts driving. And that also allows us to have new business model, for example, pay by mile or pay by hour driving or so. And that's actually been around for a while, since 1998. It also allows us, well, it's probably part of disruption, it also allows us to identify the drivers while they're driving. And then there are quite a few startups, more in the US than here, particularly in telematics, which allows us to have a better risk differentiation, this whole thing as well. And this is always a thing we try to do. We try to have a better idea of how risky you are to give you a better or more exact price. Cross-fertilization is from other fields. I mentioned the retail, the price optimization that comes from online shopping as well. There's a lot of stuff I'm having there. Fraud as well. There's a lot of stuff happening in other areas that deal with fraud, like banks, for example. Mathematics as a whole is becoming more and more computational. As I said, I've got a PhD in pure math, and we also have computers. So it may surprise people. Cost is always a driver. Wait, more data? Yeah, mentioned it already. Cost is always a driver. We have fairly specialized programs which are very, very expensive. So trying so if you can replace those with open source like R, you save a lot of money. And also, I think you mentioned that beforehand, James, it's if you manage to replace some of the tasks in pricing or so, some of the more mundane tasks that you have to redo all the time with, for example, machine learning, artificial intelligence, you can save a lot of money as well that way. And finally, if you manage to have better pricing, you can also lower the risk capital requirements, so that costs less as well. Fraud is also a big driver, obviously. If you can reduce fraud, we save money, make more profit. And there are a lot of new methods, as I said, for example, around text-to-speech analysis when people call, or also graph analysis. Are there certain solicitors and garages that seem to have a higher incidence of fraud, but always work together? One final thing about the more data. You might remember that when Admiral tried to introduce pricing based on your Facebook posts, which I think stayed up for about 5 hours before Facebook canceled that. But that's one example of new data, more data. Right, necessary changes. That's now again more in points of Hastings Direct. We need to move in IT culture from proprietary to free open source software. So you need to move away from a very closed Windows-based environment to something where you can use the right tool for the right job without having to go through a multi-layered approval system. This also means that the knowledge moves from the tool to the employee, because at the moment we use Radar and Emblem, that's specialized insurance tools which can do GLMs. And you can basically click your stuff together, your model. Once you move to R, say, or Python, you can't do that anymore. You have to write your own code. So the knowledge moves from being in a tool to being in the employee. And as I said, new products, for example, random forest is hard to turn into a table. And then the aforementioned telematics and startups stuff. Right, and the main thing, we have more data, particularly through telematics. And that's kind of a vicious circle, or the opposite. We have more data, which means we need more storage. This means we need faster storage to be able to work with it, which means we need new concepts to work with it, because we have more data, which means we have a more precise price, which means we want more data to make it even better. Right. Current working practices, at the moment, as I said, the data is stored in SQL. Can you see that? Yeah. Then there's some cleaning analysis in Excel. A lot of stuff happens in Emblem, where you do your modeling, and then it gets turned to a quote in Polaris, which I think is from the 80s or 90s. In the future, hopefully, they promise it would happen this year, but stuff will get stored in Hadoop. You can analyze on the Spark layer, use R and Python to do most of your work, and then you do your quote, hopefully, with stream processing in Hadoop, maybe. One big change is feature selection. So at the moment in Emblem, it works, you add and remove features and just refit your model and see, and then manually compare how good it is, if it's significant or not. And it's a bit, roughly correct. And that'll change to basically to the beginning of the process. You've probably all seen this, I hope. This is a isomap. It's when there's a famous example, your data is in a Swiss roll, basically. And if you just cluster on that, it doesn't work. So you basically have to flatten it first. And that it's not only that, it's also PCA for linear data. It's correlations. There's something simple as that. And then what I've recently found, a manifold reduction, which is quite exciting for me as a topologist. Maybe not for anyone else, but anyway. It is, really is. Method. So at the moment we have machine learning supervised GLMs, as you can maybe imagine. And actuaries generally do that fairly well. Now, you all know data science, I presume being in a data science meetup. Those new methods, neural network, random forest, other methods, boosted trees, whatever else you can think of in terms of supervised learning methods, they're coming. We just need to figure out how to turn them into tables or use a different code engine. Unsupervised is completely new. So there was some kind of clustering so far, but that was usually based on domain knowledge. Like, for example, the segment of your car. As I said, golf class or SUV or something smaller. With unsupervised methods, we can now finally turn that into something mathematically rigorous. Mixture models, supervised, unsupervised, hybrid stuff. And I've put this extra because it's quite resource intensive and not that easy. Spatial data, geodata, tempospatial data, time and space, basically. This is an actuarial table from, I think, the beginning of the 19th century. And this is essentially what we use now still. Not in wood, it's electronic, but this is essentially what is still being used. So we need to get away from that. And so we need to change the working practices to embrace the new methods. Become more of a software engineer, or get inspired by that using Git, using reproducible code, instead of, as I said, you just add and remove factors and see if they fit roughly. We need to have a fixed release schedule, which we have now, which is fairly long. We need faster shipping, because with telematics we can see faster what's happening. We don't have this 1 year plus feedback loop. And we also need to have code standards and code reviews. Having seen the code of some of my colleagues, that's probably the most important point. Data imputation is an important point. As I said, there's missing data and there's not really missing data. One thing that comes to mind is mice are validate in R. And actuaries need to become more of a data scientist, have to be more of a coder, and also have to get used to more of math or new math. So they have a fairly good start. They know how to do data analysis, most of them. They know GLMs quite well, but they need to use new methods. Right, potential problems. You can always get those articles from The Guardian. This is a famous one from, I think, about a year ago, where they found out that inner city areas have more claims than rural areas, and rural areas tend to be more white. So obviously car insurance are discriminating against ethnic minorities. And there was the former equality commissioner, his consultancy basically found there was a strong statistical link between the proportion of ethnic minority households and the cost of car insurance. And there was this nice quote by the ABI, the Association of British Insurers. Sorry. They said there was without any consultation by people with no understanding of how car insurers price a policy, and was paid for by a firm of solicitors with a vested interest. Right? To which the authors answered that without access to the data, they could not rule out the possibilities of other factors having a role to play, such as taste in vehicles, age, profile, or immigration status, or, as I said, the number of claims. They do that about every half year, a year. Another one, on the wrong postcodes, put the insurance out of reach when you move around from towns to rural areas. Same one. They also apparently were prejudiced against older people. There was a Sheila Hancock, I think she was about 85 and had far higher car insurance than when she was 60, not surprisingly, to be honest. Yeah. Which brings me to other problems. With this knowledge transfer on the added requirements for actuaries or data scientists in general, which is a competitive marketplace anyway, employees get more expensive. You save money on your software, but you have to then spend it on the employee. And it gets more important because as the knowledge is now in the head of your employee rather than your software, you can't really afford to lose them as much as before. There's added investment to be made. You need new infrastructure, you need bigger storage, you need faster computers, and you need to invest in your existing employees as well. Hastings Direct is fairly lucky. We only founded in 1996, so we have one central database where you can access all your data, which is, as far as I know, not necessarily the case everywhere. And we don't have as many legacy systems from the 1960s or so. You need more math. I like that. Some people don't. We have a problem with IT at Hastings in particular. They don't necessarily like change. So you need new IT people. As I said, you need to get the shift in mindset from stopping things from happening to making things happen. And then this big problem, privacy. You don't want it to have a data leak in general. Opportunities, this is probably more for data scientists now. We can learn from insurance and actuaries. They know GLMs really, really well, probably better than any data scientist out there. There are opportunities to sell specialized packages or write specialized packages, particularly in our opportunities in consulting to move away from those specialized software to more open source stuff. And there are definitely opportunities in other non-car insurance, like we heard previously. And there's also an opportunity for the insurance company to have a more complete customer view, to know more about the customer. Always with the proviso that you need to be careful in terms of privacy, what you use, and who can see it. And there's always this big thing, fraud reduction. It's always a big thing. The more we reduce fraud, the less loss we have. To summarize, insurance will have to change. Actuaries will have to change. As far as I know, they're going to introduce R in the exams about next year or the year after. So they are slowly changing. They need to embrace data science, but they're well placed to do so because they already know some analysis. They already do that. Data science need to help insurance companies because we know what to do. We know how to use it. And we can help with that. And generally, we can learn from each other.